This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 191 was recorded on October 31st, 2019. I'm Erik Townsend. Happy Halloween. This episode of MacroVoices is brought to you by TopTradersUnplugged.com, which happens to be my own favorite podcast when it comes to quant and rules-based investing. My feature interview guest this week is hedge fund manager Alex Gurevich, who couldn't be more bullish on gold. Alex is known as a fixed income guru, so we'll focus much of the interview on interest rates and bond yields, both in the United States and around the globe. We'll also take a deep dive on the U.S. dollar and the euro in the wake of Christine Lagarde taking the helm of the ECB from Mario Draghi this week. And be sure to stay tuned after the feature interview for our post-game segment. Patrick has compiled another of his famous post-game chart books and will have extended equity market coverage as well as a number of other discussions.
And I'm Patrick Ceresna. Now, Erik, let's jump into that S&P 500. We break to 52-week new highs actually all-time highs on the market. And we kind of pop into the FOMC, and we're giving it all back here today, at least FOMC pop. What's your take on the market?
Doesn't surprise me at all that we broke to new all-time highs. It doesn't make sense to me, but if you look at the way this market's been trading, it's been looking for an excuse to move higher, even though the fundamentals, in my opinion, don't really support it. I think that the next big thing, we're exactly a year away from the election, and usually that's when election-related forces start to become much more dominant in the market. Markets don't like uncertainty, so, of course, we don't know how polls are going to turn out and so forth. But to the extent that in coming months we see uncertainty as to who's going to win the election, I think that's going to put a lot of downside pressure on the market. On the other hand, if it becomes very, very clear from polls that, let's say, a re-election of President Trump is a near certainty, I think that regardless of whether you like President Trump or not, that removal of uncertainty would probably tend to support the market. So I think how the political process goes is going to weigh heavily on the market in the next year. There's lots of room for all kinds of volatility in either direction. Paul Tudor Jones made some comments at the Sohn conference this week suggesting that you could see just wild differences. If there was an Elizabeth Warren presidency, that would probably, according to Paul Tudor Jones, be very negative for the market. He believes that a Trump re-election would be very positive for the market. Now, regardless of whether you agree with those views, it should be clear that election politics are going to play a much bigger role than they have so far in the market. You'll hear Alex Gurevich make a very excellent point, I think, in this interview, Patrick, which is if you think about equity prices in terms of CAPE ratios and so forth, it seems like they're crazy overvalued. But if you think of it strictly in terms of relative to the alternative of fixed income, how much capital do you need to produce a certain amount of income yield? Equities almost look cheap next to today's fixed income. So I'm happy to be on the sidelines. I don't want to be any part of this stock market. I'm happy to be trading commodity futures.
All right, well, let's move on to the dollar index because the euro strength and corresponding dollar weakness is pretty relevant here. What do you think is the next move on the dollar from here? Is the consolidation going to continue?
Well, Patrick, as we're speaking on Thursday this morning, we touched just barely that 97 round number, so we're flirting with it again. As I've said before, if this is the bottom, okay, but if we move and get a daily close below 97, that really starts to establish a pattern of lower highs and lower lows and suggests that maybe this move to the downside has farther to go. Now, Patrick, I still am convinced that the dollar short squeeze that Jeff Snyder has talked so much about is in play here. I think it's going to continue to be the dominant force, and I think it's eventually going to push the dollar index much higher. But do we go considerably lower before that happens? I don't know. I can tell you that if we get a daily close below 97, I'm going to take my long position off just to wait this out and see what happens.
All right, now, Erik, on Monday, you were tweeted that crude oil was rallying to new cycle highs, but the time spreads were signaling the market was topping. As it turned out, the market topped within one tick of the level it was trading when you posted that tweet, and the oil since has dropped about $3 lower. So congratulations on the call. But please elaborate to our listeners, how did you know from the time spreads that the market was about to run out of steam?
Well, Patrick, first of all, the timing was pure dumb luck. It was very clear that the market was running out of steam. The fact that the tweet happened to get posted right at the high just was coincidence. But time spreads are a really, really strong indicator in some circumstances. Now, they don't always give a signal. But in this case, what we saw was the front month and time spreads rallying through Thursday and Friday last week. And then all of a sudden, the time spreads just gave out. They were collapsing on Monday morning, even as the market was rallying to new highs beyond where it had been on Friday. That told me that the rally was over or was about to be over, and that's the reason for the tweet. And it turned out that I just purely by coincidence happened to peg it right at the top of the market. Then we got the EIA inventory report on Wednesday, which helped to accelerate the selling because API, the private service that reports on Tuesday afternoons, had set an expectation for a small drawdown on crude oil inventories. Instead, EIA reported a 5.7 million barrel build on inventory. That resumes a previous streak of 5 builds in a row. Then we had one drawdown next week. So if not for that one drawdown, it would be 7 in a row. And Cushing, Oklahoma, also building 1.6 million barrels, continuing the trend there as well. The drawdowns were on finished products, gasoline drawing down 3 million barrels, distillates drawing down 1 million barrels. Meanwhile, U.S. production is holding at 12.6 million barrels, unchanged. That's still a record high level. The record was set just a few weeks ago. Imports 6.7 million barrels per day. Exports 3.3 million barrels per day. The tape action was already down in the day, but of course that inventory report just helped to accelerate the selling to the downside. But then all of a sudden, those time spreads reversed again and took off to the upside just like crazy, starting at about 12:45 p.m. on Wednesday. What's going on there? Well, this time it wasn't forecasting the direction of the front month. It was news of a leak on the Keystone Pipeline, which very directly affects inventory logistics of supply coming into Cushing, Oklahoma. So we do have the Keystone Pipeline still shut down as we speak. Now, a lot of people on Twitter are saying, hey, look at the November of 2017 spill on the Keystone Pipeline. Only took a few days to fix. This shouldn't be a big deal. I'm not so convinced of that, Patrick. The reason is this is on a submerged section of the Keystone Pipeline. So the pipe is a subterranean pipe buried underground. And specifically, this involved wetlands. So now we have contaminated wetlands. The pipe can't be repaired until they dig it up first. Who knows what kind of environmental regulation comes into play in digging up a submerged oil pipeline when what it's submerged in is wetlands that have already been contaminated? How many different government agencies are involved in deciding what the rules are for that one? So there hasn't been a clear announcement about the timeline of how long the Keystone Pipeline will be offline, but it won't surprise me, Patrick, if it turns out to take a little longer than the previous spill repairs that we've seen, which occurred on pipes that were not submerged.
All right, well, let's move on to gold because last week gold tried to break out, gave it back. Again, today we're trying to break out. We're at 15.15 at the time of recording. Is gold going to break out here or what?
Well, after we saw that false breakout last week, Patrick, I decided to start scaling into a speculative position. I've already had a core position in gold that I've held for years. I was waiting for a pullback, and frankly, I'm still convinced that there will probably be a lower opportunity to get a better entry price here. But at every turn, we've just seen unexpected strength in the gold market. So I have started buying on an unleveraged basis. As far as any levered speculation, I'm going to wait for a better opportunity, I'm definitely keeping some powder dry. But it just looks to me like we could end up breaking out of this consolidation. We've got a chart coming up in the post-game segment where we can talk in more detail, but we're seeing a break above an important trend line. That we saw a break above that same trend line last week, but it was just intraday. It was a pop and drop. We closed below it. Looks like we're going to close well above that trend line today. That potentially means a new bullish move. Again, I think there will be a lower entry opportunity before this is over. We really haven't seen any significant pullback after this really big move up, but it hasn't come as quickly as I expected, Patrick, so I'm starting to scale into a larger long position on gold. Alex Gurevich is going to have a ton to say about gold. He's incredibly bullish, so we'll save that for the feature interview.
All right, well, let's move on to the 10-year Treasury because we have a nice pop in bonds as yields are backing up to now below the 170 level as bonds are liking the fact that the FOMC or the Fed is looking to stall their rate cut cycle there. What's your take on what's going on in the bond markets?
Well, needless to say, Alex Gurevich is the fixed income guru, so we're going to save most of the bond market coverage for the feature interview. I did close, actually, my long position. I still think yields are going lower, but frankly, I don't have as much conviction as I've had before because just the way we've seen this pattern established, we're starting to see what looks to me like a pattern of lower highs and lower lows in price, higher highs and higher lows in yield. That may have reversed in the last couple of days. Maybe I closed my position at the wrong time, but I decided to just get out at break even rather than wait this one out. So I'm happy to sit on the sidelines, but we'll go into much more detail in the feature interview with Alex Gurevich.
All right. Well, thanks for the market update. Now, before we move on to this week's featured interview, we just released a new video today on MacroVoices YouTube channel. Please tell us about it.
This one is a instructional video. It's designed for advanced retail investors, and it's teaching you how to use the long-short equity hedge fund strategy to trade your own account like a hedge fund. The idea was to develop a series of advanced investing videos. That was a plan, frankly, that we had as part of the expanded new content for MacroVoices. I'm not sure that we're going to do the rest of the series, but this particular video was recorded back in July. It just finally got finished with the editing process. So enjoy it, everybody. It's on the YouTube channel. You can also find a link to it in your Research Roundup email. And by all means, let us know what you think in the comments section on YouTube.
Well, thanks, Erik. Now, this week's featured interview features Honte Investments CIO Alex Gurevich. Now, why did we invite Alex to the show this week?
Well, there's a few reasons. Number one, Alex is just a really smart big picture thinker. He's a really, really smart fixed income interest rate guy, but he really thinks long term. He's not the what's happening this week, tomorrow, and so forth. It's an FOMC week. We wanted to have somebody who was knowledgeable about fixed income markets and interest rates and so forth to comment on what's going on with FOMC. But I also wanted to get the big picture view as to whether or not Alex is still bullish on fixed income, as he has been in the last couple of times we've had him on the show, as well as to get an update from him. He's also a very, very expert currencies guy. And we've got Mario Draghi leaving the ECB. Now Christine Lagarde is taking over. What's that going to mean? I wanted to ask Alex about that. So he's just a guy who's got experience that was very relevant to a lot of things that are going on in the market this week. This episode of MacroVoices was made possible by TopTradersUnplugged.com. I did a full-length interview with Niels Kastrup-Larsen, the host of this excellent podcast, back on September 7th, 2019. The download link is in your Research Roundup email. We discussed a number of key issues about the value of having a rules-based investment strategy in a portfolio. In our conversation, Niels shared some insights that may surprise you, especially when it comes to how trend-following strategies don't really operate the way some market commentators suggest they do. For more information, including a free book about trend following and the accredited investor slide deck from my interview with Niels Kastrup-Larsen, go to toptradersunplugged.com/macro slides. Check them out. You'll be glad you did.
Erik's interview with Alex Gurevich is coming up as MacroVoices continues right here at MacroVoices.com.
And now with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Hante Investments Chief Investment Officer Alex Gurevich. And of course, listeners, you know Alex is a big fixed income expert and interest rate guy. Obviously, Alex, we need to get deep on interest rates in today's interview. But first, what's on everybody's mind is it was FOMC day. Give us the rundown. Obviously, 25-point basis cut. What's your perspective on what happened here? What does it mean? And how do we fit this into the big picture?
Okay, good to be back. So yes, today is the FOMC day, and whenever we are in the middle of a cycle of actually action cycle, that is right now in the middle of an easing cycle, every FOMC day is very important, not only in terms of what happens today, what exactly they do, but also people look for clues as to the next meeting, because it's not so easy for them to change course between meetings. So it's brick by brick, they lay out the expectations for the next meeting a few weeks ago, and this is the first significant installment of our expectations for the month of December too, not just what happened today. As of today, the market priced like 95%, or depending upon what chances you would put in, maybe even 97% chance, depending on exact computation of ease. So it was completely baked in. If you ask me, I would say that the actual probability was 99.99. The reason is that there is just really absolutely no incentive. There is no scenario, no course of discussion that would likely lead Fed to actually not lower rates today. And I can go into this a little deeper. You might see some dissents and some people saying that they don't want to do it, but reality is it's just people are just showing the philosophical dissent. Everybody knows that rates needed to be lowered today because market already priced it in. And if they didn't do it, it would be too much of a shock to risk assets and to the system. And it was completely unnecessary because there was no pressure on them. There's no inflation pressure, and we'll get back to that too a little bit. There was no data pressure. In fact, data was kind of soft last month. So there was nothing urgent that would tell them not to do it, and they could very easily do it and then manage the expectations going forward, and that's what they tried to do. So to avoid parsing exact words of Powell or exact questions in a very broad sense, gist of what he tried to convey is that basically what Fed always conveys. We currently think the policy's level is appropriate. First of all, that is almost by default truth. If they didn't think it would be appropriate, where they ended up today, then they would have done something else. So they have to, by default, be at a level which they consider to be correct at the moment, right? And he tried to convey that this might be the last cut because they have overall relatively positive outlook on the economy. There were some positives and some more negatives, some more questionable things about the economy and the global economy that were mentioned during the press conference. But overall, he tries to convey that overall, there are some risks, but overall things are okay, and this rate should be accommodative enough for the economy to muddle through at trend growth. And this is what he tried to convey. However, to me, there was a very interesting element of the message, which is very consistent with what I philosophically expected for a long time, and which I think very strongly will be the truth. But I heard much more of acknowledgement from that from a Federal Reserve than I ever heard before. Basically, the way I would translate what Chairman Powell said, that there will be the next rate hike is never.
Okay, Alex, I wanted to start with today's news, what happened at FOMC today, because obviously you're an expert on the subject. But our longtime listeners also know that you are really not a what happened today kind of guy. You're a really big picture thinker, and you've been extremely prescient in understanding in a long-term view what's going on and what's been driving the fixed income markets and rates generally. So let's zoom way back out now and give us the big picture overview of where we stand. Last time we spoke to you, you were still looking for 10-year yields to continue to move lower, possibly to new all-time lows. Is that still your outlook, and what's the big picture? What should we expect to see from here?
Definitely no major changes. I'm still expecting on this cycle to Fed funds rate end up close to zero, and yields continuing to fall, and longer dated treasuries either earning money by either getting significantly lower in yields or starting to earn significant money via carry as they did in the past years. That is, even if, for example, even if 10-year note yield stayed where it is, but the front end went to zero, we'd be earning 1.5% carry, and I would imagine the situation to persist till yields go significantly down. I think everything points towards much lower yield. I think current Treasury yield, if you look at U.S. Treasury yields versus yields on pretty much everything in the world, on all instruments in the world, this is a huge aberration spike. It defies my words to explain how cheap a Treasury bonds as an asset class relative to other asset classes. I mean, there are other asset classes that might have more upside, and we can talk about gold or cryptocurrencies or whatever. But looking like in terms of a safe asset and how historically cheap Treasury bonds are to everything else, it's been very persistent. But it's been persistent not in a sense that it's cheap and it's losing money. It's cheap and it keeps making you money as you put money in it. And it's just been a treasure trove. Sorry for the pun. Treasuries were a treasure trove, and they continue to be one. And we can go in more detail. And I think what is very interesting about, here's the interesting thought that Chairman Powell said. And this thought was actually, in some sense, it's not every time the Fed says something, it might affect today's market moves, but it actually does not really mean very much in terms of long-term policy, because generally, as far as I'm concerned, they say things that I already know. It might just affect daily price motion. But for example, when they say we cut today, but will be data dependent afterwards, there is no new information in this. Of course, they're going to be data dependent. By the same token, when they pivoted, when there was so-called pivot in the winter of 2018, I actually don't believe there was any pivot. I think the policy response stayed consistent. Things turned and they turned. It's not like there was ever any question that, and if they did not say those things, bond market would have continued to rally, because then stock market would have gone down and forced them to cut anyways. However, it is interesting to see them acknowledge certain things just as a internal mental check. So this is what he really said today during the conference call, which is very interesting. He's been very pushed on when do they think is appropriate time to raise rates. And he said, well, we really don't have any inflation pressure whatsoever. And he was very clear on the fact that there is no reason to raise rates again until inflation pressures will become ominous again. Not just go above 2%, but go above a target and sustain what, of course, there are different measures of inflation. You can argue with inflation high or low, but they basically need to some kind of very uncontroversial and sustained measure of inflation putting pressure on them. And this is just not on the cards. We're not seeing this. I have strongly doubt that we will see it in the near future, because what we're having is strong dollar, and if they're not going to keep cutting rates, dollar will just continue getting stronger, which is in itself deflationary. We can argue whether strong dollar is good or bad thing. Most people think it's a bad thing for the world, but it's also, there is no question it's deflationary for U.S. economy. And we're having very contained, of course, like commodity prices could turn very quickly. For example, oil is now very contained. It could rally 50% for all we know, and it might change somewhat short-term inflation picture in the U.S., but even that in itself probably will not be enough to precipitate rate hikes. So the bar is given the global situation, given the current interest rate differential that favors U.S. even after a recent bout of cuts, it's very hard to imagine any kind of inflationary pressures arising in the U.S., which means that basically rates cannot go higher than now, which means that everything from now on to downside is a free option. And market is not pricing very much more eases. So in the event of Fed stays on hold, you can lose a little bit of money, but if they continue going to zero, as I think, you have much more to gain.
Now, based on that view, Alex, we've come down on the 10-year Treasury yield from 3.25 more than a year ago, all the way down to a low print that was below 1.50, at least on an intraday basis it was. As we're speaking on Wednesday afternoon after the Fed, Alex, we're looking at a 1.78 print on the 10-year. So it's backed up more than 25 basis points. In a normal market, counter-trend move of 25 basis points is big. It's time to make a stand there. But in this case, we've come down 125 basis points in the last year. Is this time to make a stand and go long treasuries? Or maybe does this backing up in yields and this natural correction that we're seeing have further to run?
Well, making a stand is a very strong statement because last stands are just really sound are very good in movies, but not very good for traders. So when you're talking about make a stand, you have to be cognizant of the fact that things can always go further, and you just need to stay in business. So with that caveat, I think it is definitely time to be long, and I'm long, and I'm willing to, but I'm long with the thought that it's quite possible to take some pain in the wrong direction there. But I think, yes, yields came down quite a bit, but we also have more information. This is an unavoidable thing in markets. You not always can buy things at the best level. Sometimes you have to say like, oh, well, yes, of course, we could have bought Bitcoin at 25 cents or Apple computers at whenever it was in the year 2000, and if we trade in hindsight like this, we could be always perfect. If we put 100% of our position at 325 yield at 10-year notes, that would have been the best, right? And then pyramided all our gains continuously, right? But it's never perfect. Sometimes you miss a big move, but what you gain during that move is a lot of new information. First of all, the policy did change for whatever reasons. We did find out that there was no big inflation when in 2018 people were worried about some inflation burst in the U.S. because of wage pressure, even though that was contrary to historical evidence, but people were for some reason worried about that. But it did not happen. We have more information about global slowdown. We have more information about how inflation looks, how commodity prices look. And with new information, I think the cap on yields is just not that far from here. I am very reluctant to say to draw lines in the sand on the longer dated treasuries because they just kind of animals on themselves and the curve can always steepen if it wants to. In the front end, however, I feel like, yeah, you could go a few basis points higher, but how high can LIBOR go? LIBOR today, so the 3-month LIBOR for listeners, that's a 3-month London Bank offer rate, which is a benchmark. Today it was set at close to 191. And tomorrow it will probably come down a bit because the Fed actually eased, even though the people knew that it was going to ease. Usually after ease, it's going to come down a little more. It's actually relatively very high right now because it reflects a lot of recent funding pressure and funding shortage. It has a lot of space to go down with Fed funds, even where they are right now, probably easily can go down another 10 basis points without offending anybody, which puts LIBOR at like 180, right? And where is LIBOR have to, if you look at Eurodollar futures, which forecast LIBOR in the future, yes, they actually do put in a decent probability of rates going a little lower, but they're not pricing so much that there is a catastrophic loss on the horizon. I mean, I don't think, for example, if it's tied to 180 forever, you could maybe lose like 30 basis points on the most expensive contracts. Meanwhile, there is at least 100 basis points to run in the other direction. So that's my point. My point is in the front end, you have a very clear risk-reward profile. And even if you go on a shorter horizon, if you go to just the most immediate bet on the December Fed funds meeting, the current probability on this meeting is fairly low. It's like maybe 10% of cut in December, while there is still enough time for them to, if we see some weak numbers or maybe some weakness in the asset markets, I think the probability for the cut in December is 50-50.
Whoa, 50-50. I wasn't expecting you to say that, Alex. Please elaborate.
Well, I have traded now. It's my third major easing cycle in my career, including the cycle of 2000, 2001, 2007, 2008, and not counting the midterm adjustment cycle of 98. And by the way, where we're at right now looks absolutely nothing than 98 and absolutely everything like 2001. And I've reiterated this idea many times, at least that's my perception. And what I've observed from those cycles, what we're seeing right now is actually not at all strange. For people, a lot of younger traders have some, not to offend them, but they might have some preconceptions maybe based on charts and based on how they think things should be. But if you traded those markets and have a visceral sense of how they trade, I have a good memory how it looked, and it looked very much like this. So what happens is, within the easing cycle, there are periodic periods of risk on where risk assets do well. And then regardless what economic numbers say, when risk assets like stocks do high yield instruments and spreads, everything does well. The sentiment is very positive and it feels like no more cuts are really needed. And market very easily settles on the perception this is the last cut. And then, if anything, we should look for hikes. And that happens again and again and again. And what happens actually is another cut, because risk sentiment goes in waves. We're just completing a wave of positive risk sentiment. And that led us to the perception that we don't need another rate cut. Now, whether or not we'll have a negative wave of risk sentiment, I cannot be sure by mid-December, but just probabilistically, there's a pretty good chance we'll have at least a minor wave of negative risk sentiment. It doesn't have to be the same as last year, but it could be the same as last year on the outlier, or it could be just a more minor wave. And if this wave of risk sentiment, negative risk sentiment happens, then in combination with soft economic numbers that we're seeing, it will be very easy to price in another cut. And in my opinion, it's about as likely as not to happen.
Alex, considering that your long-term view is that interest rates will eventually go to zero, we got to talk about gold. Give us the big picture. What do you see coming in both short, medium, and long-term for gold?
Well, I see secular bull market in gold. I see we're at the beginning of secular bull market. I think the move that occurred so far, depending on where you think it's like from 1,200 to 1,500, is just a minor blip, the beginning of a move which could be several times higher in magnitude. And I think that given how we measure the previous bull markets in gold and how we're in the cycle, I would be surprised to find gold below 3,000 5 years from now. So I think that it's a very high positive expectation asset right now.
I couldn't agree more with the long-term view. If you look at the challenges that central bankers have, interest rates going to zero, they're probably going to be forced to keep them there for a long time. It really makes sense. Do you have a view about the current entry level? We've moved a lot really fast. A lot of people, myself included, were expecting there to be a natural pullback after that. And so far, we've just seen a sideways consolidation. Is it time to buy here, or do you think we're going to get better entry opportunities?
Yes and yes. In my opinion, yes, it is time to buy, and yes, we might get a better entry opportunity, but it's not relevant because the upside is way too big to wait. You see, if your upside is $3,000, say if you could go up to 4,500 on gold and make 3,000, do you really want to give it up trying to save $50 on the entry? I think you need to enter if you have that view. Not if it's very easy to have different view. But if you have that view, you need to enter, but you need to keep your positions. You need to enter. You need to have no stops. View it as an option, and potentially have a little space to increase your position size if things go against you. Of course, if that's how you like to trade. What is the worst thing to do right now, in my opinion, is enter at 1,500 and put some kind of stop at 1,400 and get stopped out of the trade just when you want to be doubling down. That you definitely should be avoiding. So you should really be cognizant of what size you can afford, and you don't have to have so much size if you think that gold can triple in price. And this is a big if, because there could be other views on gold. But if you think as you and I think you absolutely have to rush to the screen and buy gold. You need to stop this conversation, pause in the middle of this interview and buy gold if that is the view you subscribe to. And then sort out the entry levels as a later problem. That's how I trade. But of course, other people, again, might have different strategic approaches. And in terms of timing, in a sense, I know you've been talking about this a lot. In a sense, I agree that the timing on gold this year was somewhat confounding. We touched it in our previous conversation a little bit because historically, gold does not start moving till a little later in the cycle. So I was a little surprised by how fast gold started to move this summer. It was a little bit not the standard time when gold moves. But the fact that it eventually moves, to me, is much more important than what path it takes.
Well, I'm in complete agreement, Alex. I still think we're going to get a lower entry opportunity, but I couldn't agree more with your logic that you don't want to miss this. It's time to be invested in gold if you're not already, and hopefully we'll look forward to a dip down to 1250 or 1350 or whatever the number is so that we can buy more. Alex, let's move on to the U.S. dollar. We had seen a pretty significant downside move in the U.S. dollar ever since the Fed announced their, it's not QE, folks, really, trust us, it's not, policy of injecting more non-QE money into the system. Just in reaction to FOMC today, the dollar index came off of a low. Looks like maybe it put in a short-term high there. Have we seen the bottom in terms of the downside in the dollar, or could there be more to come?
Well, it is hard to tell. Again, I'm not a big expert on calling short-term bottoms, but I would point out that overall, unlike in the case of gold, the performance of dollar is generally consistent with this portion of the cycle. Typically, early in the easing cycle, dollar performs well. And I think it is very important to realize when you look at the longer-term charts, even like starting from 1 year to 5 year charts, chart of something like DXY, which is just the weighted dollar index, is very deceptive. Dollar, in fact, is performing much better than any of those charts imply because it's carrying very positively against other developed market currencies. It's the highest yielding developed market currency. So dollar euro, for example, on a total return basis, dollar euro is hanging around the levels it has not been at since 2003. It has surpassed the levels of several years ago when even when dollar euro touched like 105. If at that point you bought dollar versus euro, you would have still made money now, even though euro is higher nominally, but because of the carry, you would have still made money from that moment. So that's how well dollar has been performing recently, and I think that is very consistent. I do think I would not ignore what the Fed does with regards to dollar. It's been long my thesis. It's hard for me to measure what this QE, non-QE buy of T-bills means, and a lot of people are trying to prove to me that it's not actually going to affect liquidity so much, though I think it does. It is incrementally dollar negative, but probably not hugely. That's my feel. However, the talk about relaxing banking regulations, that is not something to be completely ignored. I think if banking regulations were to be relaxed so that banks could expand the balance sheets, that would increase the cash supply. It would be incrementally look like an ease. It would be very positive for treasuries and other physical assets versus off-balance sheet assets, but we might be going into a little bit of a technical detail here. But it would also probably be incrementally act like an easing, somewhat stimulate economy and somewhat weaken dollar. I don't know, and I don't think it's likely that the magnitude of any change in regulations or those like temporary measures by the Fed would be big enough to offset the broader massive trends that are going on in the world. So the odds on the current terms still supportive of dollar.
Let's move on to the euro currency, since I know that you follow that one quite a bit as well. We've got Mario Draghi is out. Christine Lagarde is in, effective tomorrow, is the head of the ECB. Does that affect the outlook for the euro, and what do you see on the horizon?
Well, the interesting thing that the short-term and long-term effects could be very different. For example, there is a lot of talk of Lagarde potentially being more of a fiscal impulse person. And the thing with fiscal expansion, that the first reaction to fiscal expansion could be actually negative for euro. That's what happened in the U.S. when we had fiscal expansion. Dollar originally went down in the beginning of 2018 after the tax bill passed, and then it proceeded to rally. The reality is fiscal expansion is actually not currency negative. It could even be argued to be currency positive. If you go into the math of capital account, it basically may serve to diminish European capital account deficit, because it will, if you start issuing more sovereign debt, it might increase people's desire to buy it, and not necessarily either flow money overseas or many money can come from overseas. But of course, maybe to do that, the yield will have to go a little higher first, not being like negative 70 basis points or whatever it is out there. So it's a difficult game to see how it's going to affect things. I do think, though, like right now, disclosure, I have no position on euro, which is pretty rare on me. I've been generally short euro, and I recently got flat euro. I'm long dollar against other currencies, but I don't have a strong view on euro because I feel like it's been a pretty good run. And I feel that Europe is actually next year is prepared to give us relatively positive economic surprises, because negative economic surprises already all kind of happened and been priced in.
Alex, I know that you're primarily a fixed income and interest rate kind of guy, but give us your outlook on equity markets, both U.S. and globally.
Well, equity markets, as we all know, have been somewhat confounding to many people. I've heard you talk a lot about how you struggled yourself with the dichotomy between feeling that fundamentals are negative for the equities, but technically they continue to perform really well and continuing to shrug off any selling pressure very quickly. And it is as if like there is someone standing by to buy equities all the time. And this has been the flow situation. Generally, when I have a very strong conviction, I'm generally not afraid of adverse technicals and adverse flows. However, with regards to equities, it is not my strategy to ever go short equities. The reason is that over super long horizon, being short equities is generally always wrong, with some very few regional exceptions, because eventually equities rally. And right now, when you ask me what I think is going to happen to equities, I'm caught between, caught between the rock and the hard place, right? On one side, historical pattern indicates that we should be topping here. Early in the easing cycle, equity, even when pre-recessionary conditions form, typically equities perform well, but in a more choppy fashion, make like low new highs, very marginal new highs, and eventually they start the real bear market. So what is happening right now would not be inconsistent with bear market in equities being very close to around the corner. Yet it's hard for me, unlike other people who feel very convinced that equities are overvalued, it's very hard for me to see equities as overvalued. That is just something I cannot buy into no matter how hard I try, because I still think about discount curve, and I still think about the environment of perpetually zero negative interest rates globally. And in this environment, anything that can generate any profit looks cheap. So what the P multiples should be right now is very hard to tell. And people will come back with arguments showing, P multiples don't actually matter, are not so tied to interest rates as we can think. This kind of model of just looking at yields and trying to price equities, so it does not work, that it's all equity valuations always mean revert. Yes, probably. But also, I don't see any fundamental force. Like, I don't see any fundamental gravity stopping equities from going higher. So personally, I would generally stay out of equities stay out of heavy speculations on equities if it was my choice. I wouldn't be telling people not to buy some solid companies which can make it through the cycle that they like, and I wouldn't be telling people not to short equities if they have a huge conviction. But in my strategic system, I would say, what's the point of going short equities? You can just go long bonds. Every scenario in which equities have a bear market, interest rates will go significantly lower. So why bother with equities if we can make so much more money on interest rate futures? And in terms of going long, well, you could stay long things you like to stay long, but I would not be too long because, well, that's been a pretty good run.
Finally, Alex, since I know that you are a heavy-duty fixed income guy, some people think that Chinese credit expansion is where the really big risk factor is. Some people have even gone so far as to say that a Chinese credit blow-up could cause a deflationary shock bigger than 2008 to hit the global economy. What do you think of that view, and how do you see the Chinese situation with respect to credit and fixed income?
Well, I definitely agree that there is a risk there. In some sense, Chinese situation in certain ways is new and unprecedented because China just had been so big portion of their global growth, and their credit expansion, their private debt has been both in the relative and absolute levels really, really large. And typically countries which have such weights of debt tend to go through catastrophic unwind. I don't know if there are any counterexamples to having this type of debt buildups leading to a catastrophic unwind. The time horizons are very difficult with that because of the command economy and the many tools at their disposal to kick the can down the road. People thought that things were going to blow up in 2015 and they did not. Some people are calling for a blow up of China even much earlier, even several years before that. And they keep kind of defying gravity and muddling their way through. I tend to, if not 100% subscribe, but respect the theory that as China slows down, even though the slowdown seems to be very gradual and moderate, incrementally it becomes much and much harder for them to service the debt. Because as long as the economy grows very, very rapidly, even if you're not profitable, you can service your debt through ever pyramiding cash flows. But now that the growth becomes more normal, this kind of debt expansion might be very difficult to service it. And how they're going to manage to solve it and unwind it, that's a very big question, because we don't have a history of a modern day command economy in the past. They've tried to do it and always catastrophically failed, but we don't know how could an economy of this size can deal with this with all the tools, with the Google, with whatever they have, the Baidu, or with like understanding of what's going on in the country, how to allocate resources, who they need to forgive debts to, who they need to prop, where they need to inject cash. With having all this information, can they handle it? Probably not. I think there is from just purely theoretical perspective, there is an elevated risk of what they call a Minsky moment, in a sense that unlike in Western economies, when you get like this gradual decline and then it's just kind of accelerating, rolling down the hill, there is some philosophically you can expect it might be something like falling off a cliff in China. That is, China will just be okay until they're not okay at all. And I think that's the risk that people are talking about that you've been referring to. I think philosophically there is definitely a possibility of this outcome, but I say philosophically because while we have no evidence that that's yet happening, we don't know. So far, they seem to be managing to contain things. We see all those cracks in the cement. They seem to be able to paint over it and make it look like new over and over again. And at what point it will all just crash down, we don't know. And I found that it's hard to time it. It might happen 20 years from now, and even for long horizon traders, it might be a little too long to wait. But definitely risk is to be accounted for.
Well, Alex, I can't thank you enough for another terrific interview. You run a hedge fund for a living, and as many of our accredited investors understand, you're not at liberty to talk in detail about your fund. But for the benefit of our accredited investor audience who's qualified to invest in hedge funds, how can they contact you to get your tear sheet and get connected with what you do there at Honte Investments?
Okay, so we could be found at honteinv.com. It's HONTEINV.com, and you could, if you an accredited investors, could register on this website to receive more information.
Fantastic. Alex, I really look forward to getting you back in a few more months for another update. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Alex back on the show. You know, I tend to still remain bullish bonds. I think as a tactical trader, I'm more willing to jump off that boat a little bit sooner than his long-term view. But a lot of the reasons why he remains bullish bonds, I still completely agree with so many of those views. At the same time, I absolutely love the fact that he was giving it a 50-50 that the Fed still moves in December. You know, that's something I think the market is not pricing in. So if that starts to be priced in, I think there's an opportunity to profit from that. Anyway, what did you take away from the interview?
Well, Patrick, I was shocked by just how outspoken Alex was about gold. I mean, I thought he was going to be super bullish. No surprise. You and I are both bullish on gold. But the comment about drop everything, don't even finish listening to this interview, go buy gold right now, I wasn't quite expecting. Accordingly, let's go ahead and jump into our post-game chart book. Listeners, you'll find the download link in your Research Roundup email. If you're not registered and don't yet have a Research Roundup email, just go to our homepage at macrovoices.com. Click on the red button that says Looking for the Downloads next to Alex's picture on the homepage. Jumping in here, Patrick, on slide 2, we've got an S&P 500 daily chart with some arrows showing these big rallies that we've had this year. What's going on?
Right. So to just give this context before we talk about the chart, I mean, we're at a really interesting moment in the S&P because whenever a market breaks to a higher high, if it's a legitimate breakout, there tends to be multiple months of rallying that subsequently follows that could easily see hundreds of S&P points run to the upside. But a lot of people that are relatively bearish point out very quickly that often markets will have a fake out breakout, very similar to what we witnessed in October of 2007, where the market proceeded to make a higher high, but then it didn't stop the bear market from emerging on the other side. And so to me, this breakout is so interesting, right? So we've broken to a higher high, and we're about to get the big tell. Is this for real, or is the market going to give it back, and was it a completely false start? And one of the interesting clues I wanted to point out was looking at momentum, which is an indicator that looks at the velocity of the market moves. And particularly what's interesting is that on all three prior rallies this year, there was a legitimate breakout in velocity and momentum as the market rallied. January 2019 was a no-brainer. When you wipe out, close to 20% of the stock market in short order, the counter rally has usually got some serious velocity behind it. But even the June and September rallies that we saw in the markets that just drove the markets back to their highs saw a material pickup in momentum during that whole move. Yet this entire rally we saw in October didn't even uptick momentum. And, it just makes me ask the question, does this in any way give more validity to the fact that this could be a false start? And that's one of the really interesting puzzle pieces that I'm going to be watching in the coming weeks with members.
Well, Patrick, I think that's exactly the right question to ask. As I said in the market wrap and in the discussion with Alex, you can make such a good argument either way. There's lots of technical reasons to say, hey, fresh breakout to new all-time highs could be hundreds of points higher from here. There's also plenty of reasons to say, why did the Fed just do what the Fed just did? The whole explanation of why we had to have a rate hiking cycle was so that they would have room, so that they would have ammunition to use when they needed it to fight a crisis. Well, why are they suddenly using up most of their ammunition? Could it be that they're a lot more concerned about this liquidity squeeze, which is causing repo markets to go crazy, than they're letting on? I think it's very possible. So there's room to make an argument for why the stock market maybe is about to crash 2008 style here. There's plenty of room to make an argument for why it's going to go 500 points higher. I'm happy to be on the sidelines. There's other things to trade. The stock market's not the only game in town.
Right. So what I'll just add to that is that the one thing our listeners can keep an eye out, and that's going to be the big tell, is that does the market start a sell cycle that wipes out the entire October rally? I mean, if we're back to 2,900 in short order and that entire attempt to breakout is given back, that would be a very bearish wave of price action. And for the bulls, they want to hold 3,000. They want to hold the market up at along its highs during a consolidation and then use that as a springboard to launch a rally. So those are two kind of really interesting levels to keep in mind. Anyway, on chart 3, page 3, we have the chart of gold. And last week we had that chart of gold, had a big green breakout candle, and by the next day it was already given back and it was a false start. But here we are a week later, and here's that breakout candle again on gold. Now, to me, all of the consolidation highs at around 1520 need to be broken. So even though the trend line has more or less been broken, descending trend line's been broken, those highs have not been beat. So I wouldn't call this a breakout yet, but it'll be really curious to see whether gold can follow through. The one thing I believe, Erik, is that if this is a gold bull market, it's not going to give people a chance to buy the dip at $13.50. I know that a lot of people talk about that, but a lot of the characteristics of bull markets is that the market runs and everyone has to chase it because it doesn't give opportunities to buy dips on with ease. And if this was a true bull market, then this should just take off and leave everyone behind. So I'll be curious to see whether gold can actually make a rally stick here.
Well, and I think there's plenty of room to argue either side of this, Patrick. The bear side of this is, hey, look, you've got one and only one daily candle in this chart that's moved above that trend line, and it's on a day that the House of Representatives is seriously debating impeaching the President of the United States. Obviously, the impeachment proceedings are contributing to the price of gold. If we don't have an impeachment vote by tomorrow or something, it's entirely possible this could all retrace. We could be back below that trend line, and maybe we are moving back down below the 1450 level at some point here. But frankly, as I look at this chart, if we have more geopolitical unrest, if we have more things go wrong, and certainly, what if these impeachment proceedings led to a rise in U.S. civil unrest, and you had riots going on because people didn't like the fact that the president was being impeached, or a different group of people didn't like the fact that he wasn't being impeached, whichever the case may be. That could drive a huge rally up. So we're at the beginning, I think, of something that could be a really big upside move. And I think the first thing to wait out is whether or not it's just impeachment fluff in the market that's going to come back out as we get past that vote, and also to get past those recent highs. Once we do and we get above 1525 or so, if we stay above it, then I would look for maybe a drift down to retest that same trend line as support, and then a move much higher. So as I said, I'm scaling into an unlevered position in gold, a speculative position. I still want to keep some dry powder. I think there is a good chance that we'll get a lower entry point at some point, but I don't want to miss the move either. Just as Alex Gurevich said, when gold is at $5,000 an ounce a few years from now, you don't want to have missed it because you were trying to get in at 1,400 instead of 1,500. So I'm starting to average into a position, but I still want to keep some dry powder in case we do get that move lower.
Yeah, for sure. And so let's move on to chart 4, where I have a chart on oil. And there's that top end of the range where you called the turn earlier on Twitter. But this is kind of rolling back down. But what I want to really illustrate with oil is that we're still very much bound in what on this chart shows the volume by price, the high volume nodes where the consolidations in oil really have happened. And we're right in the middle of that consolidation. So oil's not broken out in any significant way, either broken down nor broken higher. And my inclination is that this is kind of rolling over, and we probably are going to see short-term weakness before we see a more bullish turn on the other side. But will we break those lows around that kind of 51, 52 level? That's a big question. Do you have an opinion on that?
Well, I definitely agree. I think we're headed back down to 51.60, which is the lower end of this range that we've been in. There's a good argument to say that we'll get right down to $50 because that's where the low volume node is on the TPO chart. So there's definitely, I think, a very bearish air going on. Now, this Keystone Pipeline disruption, that's, shutting down a major pipeline that brings oil into the United States because it is in wetlands and there could be some environmental complications and the repairs might take a little longer than people are assuming. That could be a really big deal for the oil market, yet still the bottom's falling out of the price, even on the day that news is unfolding. So it really tells you that the oil market wants to move lower here. Getting back down to 51.60, unless something big changes, seems like a cinch to me. The question is what happens from there. Do we get the next move, which is down to $50 even? That's where the low volume nodes are in the TPO charts. And if we saw a break below that, there's not a lot of support below that. It would really open the door to a potentially significant move lower. Everything we've seen, though, so far is, for quite a while now, this 51.60 level has been saving the day. So it'll be interesting to see what happens when we get back down there.
All right. Well, on chart 5, what I wanted to just touch on is that 10-year Treasury yield. I mean, you talked about it in the market wrap at the start, but what I find fascinating about this consolidation is a technician can see two things. One technician that wants to be bearish bonds will be looking for that as a double bottom on yields, while someone who is bullish on bonds will look at this as a sideways or like horizontal triangle or a flat pattern that's a consolidation that will ultimately be a midpoint for a continuation pattern. And one of the big tells for me is really about 5 or 10 points lower as we approach 160, 165. Because if we see yields, let's say, go south of 160, we're going lower. I mean, at that stage, I would even be banking we're going 130, 125, which is, I've been incredibly neutral bonds, and that would certainly make me feel like I need to put a position on with some urgency. I'm actually wondering whether I should be in at all right now, or rather should be already positioning. But I just wanted to point out that this is a consolidation will reveal a lot in the coming few days here.
Well, you can also argue the other side of this, Patrick, which is that last low was a higher low, and if we get a series of higher highs and higher lows, that starts to say that we are headed toward higher yields. As you said, if you go below 160, we're probably going much lower. Well, what happens if we get a daily close above 190, which is about where that green candle was a few weeks ago in September?
Well, that's what we'd call the double bottom, right? Like
yeah.
that's what the bond bears are looking for, right? Is that, you want to see that the yields find support here, let's say 165, roll back up and punch 190 and higher, and that really solidifies an intermediate time frame top in bonds and bottom in yields. And so I think that in the next couple of weeks that we're going to get the market's going to reveal a lot of these interesting things. So moving on to chart 6 here, we have the chart on the euro dollar out in the December 2019. And what I find fascinating here, Erik, is that it really doesn't look like the euro dollar markets are worried about the Fed. And in fact, what I'm going to be watching so closely, I mean, Alex was saying that it was like a 5 or 10% chance of a cut in December, but it would be so curious whether or not this bullishly breaks out on the upside, forcing the hand, and the market once again playing a scenario where they're pricing in a cut and making the Fed either have to oblige the market or disappoint. So one of the more interesting things I'm going to be watching here in the coming week or two is whether or not these euro dollar futures break out on the upside.
Yeah, it's going to be very interesting. And of course, the other thing that relates very closely to that is, do we continue to see this repo market craziness? I think a big reason that the Fed made this most recent cut and this whole series of cuts is because they're afraid of what's going on in the repo market. Is that liquidity situation going to solve itself, or is it going to get worse? That's going to play a big role in this. In any event, we're going to leave it there in the interest of time, folks. Today's episode of MacroVoices was made possible by TopTradersUnplugged.com. Be sure to check out my full-length interview with Niels Kastrup-Larsen, published on September 7th, 2019. The link is in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Shame on you. Go to MacroVoices.com, register your free account, and the benefit to you is you will receive our Research Roundup email each week, which contains a list of links to all of the best free content that we could find on the internet each week. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as the link to the charts we discussed in this postgame. There's also a really interesting article I linked in there from Chris Whalen titled The Repo Madness and the Rest of the Story, and it kind of gives some great color on that repo thing you were mentioning. As well, in Canada here, we had the general elections, and there's an interesting David Rosenberg piece I linked in there on the new Canadian government, which is saying the last time the Liberals had a minority, investors had no place to hide. And so you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.